The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ian King. These are your headlines. European equities seen ending the week on a downbeat note as Asia finds itself in the midst of a steep sell-off. This after Apple and Microsoft announced price hikes as the AI race squeezes chip supplies and prompts fears of higher inflation.
The UN halts efforts to escort ships through the Strait of Hormuz after a vessel is attacked off the coast of Oman. US officials are blaming Iran as the preliminary peace deal comes under early pressure. The UK prepares for a new Prime Minister, but leading opposition figures tell CNBC they have doubts Andy Burnham can turn around the UK's fortunes.
If you ask the business people in this room what is the most important things that we could be doing for the British economy today, I'd be surprised if you could find a man or woman who says that Manchesterism is the answer to that.
He's written a lot, he says things, some things I've agreed with what he says, but I'm afraid, don't call me cynical, but I want to see what he actually does, not just what he says.
Proving a challenging Friday already from the outset. We've got a lot of movement across the Asian markets and across international markets. So let's just get into that. Ian and I are going to have a chat about what is playing out in the backdrop in a moment. And first up, we've got a reversal again. You can see Japanese stocks down heavily, 4.5%. We've got a big drop on the South Korean market, more than 6%, let's call it 7% as we round up. And across those other markets that have actually not been trading that firmly anyway. The Hong Kong market is giving back territory too, along with Chinese stocks. So red ink across the board. The Asian tech space in particular, stocks there under pressure amid concerns over the rising cost of AI infrastructure. SoftBank is leading the losses over fears that the OpenAI IPO could be delayed until next year as it reportedly struggles to secure demand at a $1 trillion valuation. A look at US futures ahead of the session. This is the picture. It does look as though we've got the Nasdaq seen down. Again, the range, it's 1.2%. We've seen sell-offs of more than 1%. In fact, no movement on the Dow at this hour. So it does look like somewhat of a mixed bag. European futures, this is what we're gearing up for at the start of the session. It does look very red at this point. We did have a day yesterday where we popped higher. We're up 0.8 on the Stock 600. So we're looking to give that territory back today. So Ian, good morning to you first up.
Hello.
What's happening behind the scenes? To me, it feels as though these markets are struggling to hold on to the higher ranges. And if you look at the Nikkei 225, you look at the South Korean market, we've gotten really bumpy at this higher altitude level. So there's a digestion issue at this sort of escalation that we've seen on the back of very strong chip gains, very strong tech gains so far this month. Yeah. Is it just end of month, end of quarter, end of half selling that we're experiencing at this point, or is there something deeper than that?
Well, it's quite interesting, isn't it? You look at the Dow Jones and it's actually in positive territory and it's been called higher at the open. So it feels like there's a bit of a rotation going on into sort of non-tech stocks anyway. Some of the industrials, I mean, Caterpillar the other day, decent numbers from them. But it's a cocktail of things, isn't it? You know, you had that high inflation print yesterday in the US as well. You know, there's sort of a lot of noise coming out of the Fed now that potentially there's a rate hike in the offing. And then, as you say, Karen, a lot of these semiconductor stocks are just priced to absolute perfection. They've been on a fantastic tear. You know, personally, it feels quite healthy that you do have these corrections from time to time. And then obviously yesterday we had the Microsoft news as well.
Yeah, it's really hard to call a double-digit fall in one session healthy, but it comes in the context where we have seen gains. I mean, the semiconductor index so far for the half up 76%. Yeah. So in that context, you are going to get bigger drawdowns when there are sell-offs. Something we spoke about earlier in the week. If we have a day of selling, there can be some forced selling that piles on top of that selling, which magnifies the moves to the downside. And we know that there is some window dressing at this point where some investors are keen to lock in those gains for end of half, end of quarter, and all the window dressing that we're seeing now at the end of June. So it could be a feature. The other point you mentioned around inflation, we had it in spades yesterday. I mean, the Apple announcement when it hit, we knew that it was coming in terms of price hikes, but it was out there. You saw the prices actually go up in real time, Microsoft as well. And that has consequences as you put OpenAI into the mix, where it may now say, look, that IPO window isn't necessarily open for it this year.
Well, You look at how much money was raised by SpaceX, and then you've got OpenAI and Anthropic both looking to go in the second half of this year. SpaceX are now doing a bond issue as well, 25 billion US apparently. SK Hynix are listing in the US, again looking to raise around $25 billion. There's only so much money to go around, isn't there? And I wonder whether that's a factor as well.
Yeah, fundamentals, I think, are coming into the mix a little bit more. So SpaceX got away, and it felt as though everything was completely detached. We're now starting to try and colonize Mars, and we're willing to underwrite that, as well as some of the other sort of spicier adventures he has. Even data centers are still frontier technology at this point, data centers in space. And all that got funded. I think the market was saying, well, everything's going to get funded in this market. But Micron early in the week gave us the impression that there were issues at play around the valuations around chips, and these are, the real diversify for a lot of people. Where they think that tech is detached from reality, they like the chips because there was still the money coming through on the revenue and the earnings side. But Micron had to prove that fundamental story was still intact.
Yeah, absolutely. I also wonder whether this is going to recalibrate sort of broader thinking around AI. How much value is actually going to be created by this? You talk to CEOs and it is on the minds of CEOs, the fact that they're going to have to put a lot of capital into this sort of stuff with potentially negligible outcomes. It's not going to deliver an immediate return on investment in some cases. So it's understandable that people are rethinking all this stuff.
Yeah, indeed. And there's perhaps a cheaper way of rolling out AI, not just these very expensive proprietary systems that we've got so far. But let's just move on to Apple and what we saw in the stock price yesterday. Apple shares under pressure, down 6% yesterday, the largest single-day fall since April last year, after the company announced an increase in prices for most of its products, not the iPhone, crucially. It was the other devices, the Macs and the iPads. The tech giant blamed the memory chip shortages for the rise. Now, MacBooks and iPad prices jumped around 20%. iPhone prices remained untouched. It has raised new fears over inflation finding a new route into the economy, with memory chip prices soaring as demand outstrips supply, with Microsoft also announcing price hikes for its Xbox devices and its second rise in over a year.
Meanwhile, the Federal Reserve's primary price gauge, as we were just discussing, rose at its highest level since 2023, reinforcing the central bank's recent tough talk on inflation. Core PCE inflation hit 3.4% on the year. That was the highest since October 2023, and 0.3% on the month. Both were in line with estimates. Well, in interviews with CNBC, Chicago Federal Reserve President Austin Goolsbee and New York Fed President John Williams hinted at optimism on taming inflation, but neither suggested rates would be changing anytime soon. Goolsbee said inflation is still trending the wrong way, although there have been a few bright spots.
We've had periods where we were making progress, then we kind of stalled out on the progress. Lately, it's been going the wrong way. But some of the going the wrong way is driven by what we hope to be temporary events, wars, tariffs. These are things that are supposed to be one and done, and then you would see the inflation going away.
Aditya Bave joins us now, head of US Economics at Bank of America Global Research. Aditya, thank you so much for joining us. We've been talking about you all week, and we've been talking about your research all week, the 3 rate hikes that you're anticipating from the US Federal Reserve. That is the most hawkish view out there in the marketplace, and you compare that to, say, Citi, that is still anticipating rate cuts. Why do you think you've got a US Federal Reserve that's now going to be willing to respond to inflation threats?
Good morning. Thanks for having me. So I would think about the new call in terms of both the data and the Fed's reaction function. On the data, it's simple. The unemployment rate is flat over the last year. Core PCE inflation is 70 basis points higher. Some, but not all of that, is due to one-offs. And the policy rate is 75 basis points lower than it was last year. So for us, the Fed's clearly offsides. You don't need VAR to see that. There's a problem here. On the reaction function, what I would say is the June SEP was a lot more hawkish than we were expecting, not just because there's 9 folks predicting hikes this year, but also because they're predicting that despite no drop in the unemployment rate. They're not looking for labor tightening as a prerequisite to raise rates. And finally, Chair Warsh, he had his opportunities. He didn't really push back against the case for rate hikes.
The pushback that we've seen from others in the economics community, because I've been probing all week on the back of your report, and the view was that, look, the PCE, even before it was released yesterday, some were willing to rip it up, saying we've got a peace deal of sorts, so it doesn't matter, it's rearview mirror when it comes to that inflation data. And the other point is that the AI story is going to bring enormous productivity gains. We're going to get the growth without the inflation. It is going to be deflationary down the track. So we shouldn't be too worried about that inflation story. What would you say to those factors?
So on PCE, I would just mention that I didn't even talk about energy prices. Our call has very little, if anything, to do with energy prices. There's been a little bit of pass-through to the core via airfares. That can roll off, and maybe you'd be at 3.3% instead of 3.4%. That's still a massive miss relative to the 2% target. And then on AI, timing is everything. So before you get the supply benefits from productivity, disinflation, first you're going to have potentially an inflationary boom from demand, from the data center build-out.
Yeah. And also, as we've just seen from the announcements from Apple and Microsoft yesterday, I mean, this AI spend does appear to be feeding inflation.
It is feeding inflation, and by the way, the Fed isn't talking about this yet, tariffs are already rolling off. So your 3.4 number looks even worse than it would have looked in, let's say, January.
What's interesting though, looking at your notes, is that you seem quite surprised at the resilience of spending on credit and debit cards, ex-gasoline.
Yes, it's been really quite impressive. There hasn't really been a slowdown ex of gasoline. You haven't seen the increase in gasoline prices, which peaked at 50%. That didn't squeeze the rest of the consumer wallet, and we're able to track this almost in real time via the data on BSE card spending. So what we've seen is a resilient consumer, probably in part because of fiscal stimulus. You had a $50 billion increase in tax refunds that was almost timed exactly with the Iran conflict, right? So consumers holding up well, which again means there's less need to be concerned about the activity side of the mandate. And what do lower oil prices do? On the one hand, sure, they reduce upside risk to headline inflation, but they also make the economy more robust. So maybe you get more of a demand stimulus for inflation. So it's not obvious to me that the drop in oil prices is necessarily all that dovish from the Fed's perspective.
Can I just tease out a little bit more about the commentary that we're not going in a straight line towards deflation? Because for me, on all the data, we're not going in a straight line. I had a very similar conversation around the unemployment numbers too.
Yep.
That's going to be bumpy now as we talk about AI. So when it comes to the eventual outcomes that AI is going to be delivering, how do policymakers navigate any heat in inflation, any weakness in the unemployment? How do they smooth that cycle?
So I guess you're talking about the potential for job losses from AI, right?
Or higher inflation. It could be very mixed signals that they get for a while.
So in the near term, the demand boom would mean more jobs and higher inflation. In the longer run, the supply shock, the concern would be that it's productivity enhancing, but you could lose some jobs along the way, and that's disinflationary. So in the near term, it probably means you want to be more hawkish. In the longer run, it's still an open question, because remember, productivity raises your neutral policy rate. So it's disinflationary. You don't need to be as tight, but you also aren't as tight as you would think because your neutral policy rate has gone up.
How quickly should we start to get nervous about the dynamic between the administration and the Fed? Trump was obviously very, very critical of Jay Powell for not cutting rates. The expectation until fairly recently was that Walsh would do so. But here he is being quite hawkish. The president's not going to like that.
That's something that's outside my wheelhouse. All I'll say as a statement of fact is that during the June press conference, the president said that he would be okay with the Fed raising rates.
So he's going to give him some time then.
I'll let you decide.
What we don't have, though, is clarity on Walsh's dot. That was missing from the last meeting. And if you're talking about 3 rate hikes, then the rest of the market is not at 3 rate hikes. And Walsh is not going to be communicating where he feels he's going to be bearing his conversation points and a whole bunch of task force probes and investigations and not providing any clarity. Does that mean we could be in for somewhat of a shock on rate policy?
Potentially. So Walsh has said that he wants the markets to observe the data and make their own decision on what that means for Fed policy. There's 2 types of Fed chairs that might do that. One would be a person who just eventually follows what the markets are pricing, and the other would be one who's willing to deliver those big shocks to markets. We'll see which one he is.
Do you want to talk to us too about yields of the dollar? Because the market, despite being a little bit mixed in terms of where it thinks yields are going from here, we've still had a dollar that has shown some US dollar exceptionalism, and also there's been a little bit of heat in yields at any given week. What do you make of how we're going to see those correlations between the pair?
So the markets have now priced in about 1.5 rate hikes through the middle of next year. We've gone from 2 cuts to 1.5 rate hikes, and I think that's probably driving the strength of the dollar. If indeed our forecast is correct and they go 3 times, there's probably a little bit more upside from there on out.
Fascinating, Aditya. Thank you so much for joining us today. We very much appreciate the conversation. Aditya Bave with us, Head of US Economics at BofA Global Research. Coming up on the show, a cargo ship in the Strait of Hormuz is hit by a projectile, pushing the International Maritime Organization to pause efforts to evacuate ships and sailors. We will bring you the latest after the break. Plus, we'll discuss the impact of the heat wave here in Europe and what cities and organizations can do to become more climate resilient. That is ahead later this hour. And the CEO of US retailer PacSun joins us in the studio to discuss international expansion, as well as purchasing power and Gen Z's buying habits. Stay tuned for that interview, 8:30 BST.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. The International Maritime Organization has paused efforts to evacuate ships and sailors from the Strait of Hormuz after a cargo ship was hit by a projectile off the coast of Oman on Thursday. A US official told MS Now that Iran was behind the attack. Well, Dan Murphy has filed this report.
The Iran deal is already facing its first real test. The Singapore-flagged cargo ship, the Ever Lovely, was struck on its starboard side off the coast of Oman. The UK Maritime Agency says the ship's bridge was damaged, but there were no casualties, no oil spill, and the vessel has already continued its voyage. But the geopolitical impact could be much bigger. MS Now, citing a US official, reports Iran was responsible. Reuters, citing 2 US officials, says the strike was carried out by an Iranian Revolutionary Guard drone. At the same time, Iran's newly created Strait Authority is now warning that any ship deviating from Iran-approved routes has, quote, no guarantee of safe passage. The UN's International Maritime Organization has now paused its outbound evacuation of stranded ships while it rechecks those safety guarantees. The timing of this is significant. The latest flare-up in the Strait happened just as Secretary of State Marco Rubio was wrapping up his Gulf tour, a visit that appears to have been well received by regional allies. Rubio saying the Trump administration will not pursue peace at the expense of its partner's security after attending a meeting of the GCC in Bahrain following stops to meet regional leaders in Kuwait and the UAE this week. Meanwhile, the war of words over this deal is continuing. Washington insists Iran's unfrozen funds can only be used to buy American food. Iran's parliamentary speaker mocked that claim in a post on X overnight, saying the only crop the 2 countries share is, quote, decades of mistrust. The White House dismisses that rhetoric and has said in the past that Iran's public messaging is very different from its private conversations. Finally, there's another regional flashpoint to watch: Iraq stepping up pressure on OPEC and urging the group to review its oil production quotas. That comes after reports Iraq could even consider leaving OPEC over the dispute. The Iraqi oil ministry has since denied those reports, saying they do not reflect the government's official position. It's back to you.
Well, joining us now is Aristides Alafouzos. He's Chief Executive of Okeanis Eco Tankers Corp. Aristides, very good morning to you. Before we get into a sort of broader discussion, I just wonder whether you've got any specific observations on this incident overnight, or what you're hearing from your sources.
Good morning, and thank you for having me on. Look, my personal view is that the attack yesterday won't significantly change the transits that have been happening over the past week. We've seen a large increase, especially on the crude oil passages. And I think this is set to continue. And maybe this one-off event isn't enough to really disrupt the recent events of the large exports of Kuwaiti and Emirati crude oil from the Gulf.
Well, let's hope so, yes. I mean, the US administration is saying that crude flows through the Strait of Hormuz are now back to pre-war levels. That's not what some independent commentators such as S&P are saying. They think it's only at around sort of 57, 58% levels.
It's hard to know for sure because most of the ships that are transiting turn off their automatic identification system. And there's a lot of jamming in the area. So it's very hard to understand exactly how much is going through. But from my perspective, I mean, I think the Emiratis and the Kuwaitis for sure are exporting, and perhaps at the beginning, they might be exporting more than their production because of what they had in storage. The Iraqis are not exporting as much because they don't have as effective control of a shipping fleet. So they need to outsource that to traders or oil companies. And the one big missing factor is the Saudis. For now, we haven't seen them export almost anything from inside the Arabian Gulf, and everything is coming from Yanbu in the Red Sea.
Obviously, the focus is on oil products, but what about other commodities such as fertilizers, which are crucial, particularly to a lot of customers in the Asia-Pacific region? What are flows like in those particular products?
Well, I have much less insight outside of the oil sector, but I think anything important is finding a way to get in and out over the past 25, 30 days. There's been a slow reopening before the peace agreement, and now there's a steady flow for all critical goods.
Can I ask you about what happens from here? Because the optics of this projectile in the Strait of Hormuz suggests that the Iranians still have control over the Strait of Hormuz. There's been ongoing conversation as to whether we're left with some sort of toll booth or fees through that shipping strait. If that were to be the case, what would it mean for you as a company operating on that strait?
I mean, the agreement is a bit not clear, and it seems that for the first 60 days, there's sort of free passage via the Omani route for the more Western-related ships and via the northern route for Iranian-linked. Going forwards, it's challenging. It's not exactly sure what will happen, but whatever tolls there may be, if there are, these need to be non-sanctioned and able to be paid and used by Western services. So, I mean, I think that's the critical factor, how sanctions interplay with whatever passages are open in the future.
To what extent have you seen insurance costs come down because there is some progress through the Strait of Hormuz? Has that moved in a material way?
Yeah, insurance costs have materially reduced. They were over 5-6% of the vessel's value a month ago, and now they've come down somewhere between 1% and 2%.
Let me ask you about oil sanctions too, because there's been a lot of allegations about your company and also a family-owned company moving sanctioned Russian oil. Is that the case? Can you confirm that?
No. Any business we've done has been under the price cap.
So do you want to just explain that to us? So you are moving some Russian oil, but it's not sanctioned. Is that what you're saying to us?
No. In 2022, the US and the EU and I think Australia and a few other countries, they set up the price cap where the traders who are moving the oil, as long as they confirm that the price is below the price cap, that you're allowed to move it using Western services. And this was done. But in Okeanis Eco Tankers, we haven't lifted Russian crude under the price cap since 2024.
Got it. Let me ask you more broadly then about the implications of security, because it feels as though what we've seen, the disruption through the Strait of Hormuz from the Middle East, product sense, but now some process to allow Iranian oil back into the mix, it feels as though energy security is all dominant. How do you think that's going to impact flows? Because I know Asia is looking to also bulk up in that region, have its own security. Do you think we're looking at a landscape that is changing and one that you're going to have to respond to?
Look, I think I touched a little on this earlier, that at the moment we see that Saudi Arabia is not exporting its full capacity. And on the buying side, we see that China is still heavily sitting back and not purchasing. So there's this weird imbalance. And I think once we see the Saudis producing again and once we see the Chinese buying again, it's obviously very positive for companies like ours, because we'll have more oil on the water and more buyers trying to purchase that oil. But going forwards, I think it's clear that some of the Asian economies need to diversify their crude supply. This is something that has been told to us by traders on a recent visit to Singapore, that some of the Asian economies, they cannot buy 80-90% of their oil from the Persian Gulf or the Arabian Gulf. They need to diversify also to West Africa, to Brazil, to the US Gulf. And these, let's say, strategic or geopolitical safety measures create inefficiencies, and inefficiencies are always positive for shipping and tankers.